Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Thursday, February the 16th. We're sort of halfway through this first quarter, and you would have to say that for much of the first quarter, oil prices have been stuck like a barnacle on a rock at around $85 a barrel, and that's more or less where they're sitting this morning, a little bit up in early trade. Sort of bouncing around and nonetheless looking up 0.5%. Clearly a market sort of searching for directions, stable, maybe even boring on some levels, but nonetheless holding firmly still at $85 a barrel, despite what one might think is a lot of outlook that is somewhat, at least as we were led to sort of understand to be a global economy moving towards recession, as we were told by the IMF managing director on the 1st of January, since sort of she has backed away from those sort of gloom and doom. But nonetheless, the outlook seems to be a world of two halves. Neil Atkinson, former head of Oil Markets Division, IEA. Neil, less than a week after Russia has unilaterally announced a 500,000 barrel a day cut, how do you see this market? Are you on the half that says we're moving into a bearish destination, or the other half that says China's reopening and all will be well?
Well, on the assumption that China's reopening does continue on the path it looks to be heading right now, it does look as if global oil demand is going to grow very strongly in 2023. There's little doubt about that. And my former colleagues at the IEA put out their latest monthly report yesterday, raising their estimates of demand growth for the world in 2023, only by a little bit, but it's now 2 million barrels a day. But of that 2 million barrels a day growth, half of it is expected to come from China, and within the Chinese number and within the rest of the world, about half the growth comes from jet demand. So, on the assumption that China pulls along everybody else as far as global oil demand is concerned, then I think we are in for a reasonably strong market in 2023. Although in the early part of the year, subject to further reductions in Russian supply, we are well supplied in the first half. The picture could change in the second half as the impact of Russian sanctions takes hold more. But certainly for this first half, I think we're in a pretty good Goldilocks market. Not too hot, not too cold, just about right.
Goldilocks market, not too cold, not too hot, just about right. I like that. Where's the porridge? Let's go to Ali Riyami in Oman, former director of marketing at the Ministry of Oil and Gas there, as it once upon a time was called. Now it's Energy and Minerals, I believe. Ali, your thoughts on the decision by OPEC, or not by OPEC, that's the point, ultimately by Russia, to make this unilateral cut last week, and what does that indicate to you, the sort of solidarity, the cohesion of OPEC Plus as we move forward into 2023?
Good morning, first of all, everybody, and nice to be invited again to participate on this morning sessions. Actually, I was interviewed last month by some of the local newspapers here. And I have predicted that Russia one day they will decide to reduce their production, subject to more sanctions from the G7 and also from the European countries. And I wasn't really surprised to see that they have decided just last week or a few days ago that they will reduce their production. So this is, to me at least, it was expected. And I think the conversation or telephone call that happened between Putin and His Royal Highness Mohammed bin Salman, I think that was to discuss this cuts outside OPEC, but it was to discuss maybe the consequences of that and what that will be, how the impact will be in the market and so on and so forth, and also to draw like a roadmap for Russia for the coming few months until OPEC Plus meet again 2 months from now or less. So I think it was obvious to me that Russia will take this decision one time, and it's a sovereign decision. And I think some other guys that were asking me, why do you think that the decision was from Russia without going back to OPEC plus and discuss this? But I said, this is typical the sovereign decision. And it is again the OPEC Plus as a organization. It is just a friendly organization. There is no binding decisions from there. No legal decision. No legal bindings on any decision from any countries. So I think I actually was expecting. But the question is that what is the impact of this 500,000 barrels to the market? So far we haven't seen so much. But we will, like always, I say that we will have to wait and see. Maybe there is more to come. Nobody knows.
More to come. Let's go to Geneva and joined by Rustin Edwards, who's the head of fuel oil procurement at Euronav. Your thoughts, Rustin? It seems that the outcome of the sanctions and so forth is putting some stress on the shipping sector. We see that the dark fleet from Russia supposedly, being stretched, as the word might say, making massive long journeys now with products going to Asia as well as crude before it. And now we're seeing some ships being refused entry to European ports or indeed being held. Your thoughts on the impact so far on the sanctions and its sort of penetration into the tanker market?
Well, I mean, the sanctions themselves have been, I'm going to say bullish for the tanker market in general, just because of the longer ton miles, as you just mentioned. I mean, product has to go further afield now, away from the standard market location of the EU, where Russia was putting the majority of their oil product and a lot of their oil waterborne exports to other markets to A, abide by the EU embargo, and B, to find a place where they can land the product, blend it, and turn it into something else to get out of the price cap. Much to this 500,000 barrel a day cut that Russia has announced for the month of March, that can be attributed to probably to more refinery run cuts than anything else. And it looks like crude exports, at least for the time being, have not been impacted because the products is where they have the problem from what at least I can see from the makeup of what makes up the dark fleet. They have a very large set of dirty product tankers that can carry fuel oil and crude oil, but the clean product tankers is a smaller subset, and that's a fairly large volume that they have to handle. And to find places to go with it is tough to go. They have found markets for their gas oil into Africa, into Asia in some markets as well, which has then displaced gas oil that would normally be exported from Europe into Africa, back into the European market, which is coupled with the demand loss that's going on in the EU and the United States. We do see product stocks have been building for the last 9 weeks now, both in the United States and the EU, I think overall, with crude stocks building in the East. So, from a well-supplied market, tankers are becoming a bit more delayed when they start getting into the eastern discharge ports. And so that's just going to add to the ton-mile argument and put more strain on the exports.
I wanted Neil to talk a little bit about the idea of this, the increased forecast by the IEA, although it's not a major increase, but nonetheless, it's been an incremental one over time. Now at 2 million barrels a day, announced yesterday on demand growth for 2023, up to 2 million barrels per day. Your outlook on that, will OPEC Plus have to revisit with the 2 million cut on quotas? Okay, nonetheless, but generally recognize that it took 1 million barrels off the market. Now the Russians are taking an extra 500,000. So if you add it all together, it's sort of 2.5 million, at least on paper. Will the OPEC Plus next due to meet in June in person at ministerial level, will they have to look at raising supply to meet this soaring demand as you expect with the China reopening?
Well, I mean, they've been keeping a watching brief. I mean, you said they don't meet in person until June, and that's certainly the case. But the Ministerial Monitoring Committee meets on a regular basis. And I'm sure that if the market conditions really were to change dramatically and we were to get away from this current situation of relative calm, then they would cool the market. I think that would be the responsible action to take. But we still need to be cautious here. China is the key to the direction of the market at the moment. China's demand, even more than what's going on the Russian supply situation, which is obviously very important. One of the tendencies we had at the IEA, and I'm not speaking on their behalf in any way, we tended to underestimate demand growth or demand. We tended to underestimate. There was a systemic issue, partly to do with the quality of data and various other issues. So I'm not surprised that they've raised their demand outlook. And unless there is a problem in China, I suspect they'll probably do the same again. So these demand pressures may well continue to build during the first half of the year. But I don't think that is a problem because there is plenty of supply out there. Brazil, Norway, Guyana, I've probably forgotten the others, Canada. There's still plenty of and the US. There's still plenty of non-OPEC supply growth out there. And as we have seen, countries within the OPEC Plus alliance are perfectly capable of making their own individual voluntary changes to their outlook. So yeah, I'm not too overexcited about what we read about in the last 24 hours in terms of the market outlook.
Ali, it begs the question, again, it's the perennial question of the outlook for demand growth. I mean, 2 million barrels a day, if we take it at face value and accept that it's true, where would it come from? Where would that new supply come from? Where the IEA also saying yesterday that they expect this year as part of that demand growth for record demand levels to be reached, I mean, to soar above pre-COVID levels. Where is that 2 million barrels of extra supply going to come from to meet this demand? Does OPEC Plus have it, for example?
Well, actually, we have to, first of all, I fully agree with what Neil has said and his analysis about the demands. But I don't see any pickup on a big pickup on demand recently in the coming future.
Well, the IEA says 2 million this year.
Well, IEA, they can say whatever they want to say, but
they also said Russia was going to lose 3 million last year. So yes.
Well, again, we see Russia. Russia producing what, exporting 8.2 million. So there is no impact on that. So IEA's numbers, I agree with Neil. It's a bit have to be taken with a caution. Especially with us here in the region. So I think I don't see any pickup on the demand, actually, big pickup. I mean, I know that there is a very good indication from China and also from India that there is now more optimistic picture on China. So those all are good news. But again, don't forget that, like he said, Neil, he said that there are other suppliers. I mean, there are new suppliers that are coming in, new production is coming in from different countries. So I don't think that OPEC Plus, they're in a rush to increase their production or to change their policy of reducing the 2 million. By saying so, I mean, we shouldn't also take away any risks when it comes to growth in different countries in Asia. Everything can happen in the future. I mean, we don't know what is the consequences of a different kind of disease or corona coming back to China. So everything can happen. So we shouldn't really rush, and we should wait until we see in June, I think, when this ministers face-to-face meet in Vienna again. So and decide what to do. But I don't think that there is enough justification at the moment to increase or to change OPEC policy. We should continue, and things are working, and the price is 85 now.
What happens
it's all good?
If Russia continues in this? I mean, if you take the view that Russia cut, at least as they announced, as a political move, a reaction against the burden of sanctions, if it was they had no choice because their production was being, is declining because of the lack of access to technology and so forth. But if you take the political point of view, as they did with natural gas, they could weaponize gas through the course of 2022, started with a little bit and then continued till it practically went to zero. Where do you think it goes with oil? I mean, if one was to go another 500,000 in the sort of oil exports from Russia become part of their sort of battle fighting the global sort of face-off with the West, as the West are doing to them, right? The West are imposing sanctions. They're also weaponizing energy, but more action by the Russians. Do you think OPEC Plus could absorb that?
Well, yes, they can always absorb that. I mean, like I said, I mean, I don't think that, Russia, they took this decision without discussing with the major producer, which is Saudi Arabia. I'm sure that the call between the two leaders, they have discussed this and they have agreed the way forward. So I think they are very well prepared. What I'm saying is that, this is just the beginning. I think Russia, although that they are facing a technical and technology issues on their production side, but again, I think this is to reflect the impact on their on the sanctions to their country. And this is, again, it's a sovereign decision, but I think OPEC can absorb this, and the extra capacity, if they need to increase their production, I think it is there from a few countries like UAE and also Saudi Arabia. They can easily produce more than what is their quota now. Oman can increase another 100 or 150,000 barrels.
Oh yes, excuse me.
Because
wow.
we have the capacity of producing 1.1 million, and we are producing less at the moment because of the OPEC Plus decision. So we can easily go to 1.1 million as a production with the condensate, of course. With the condensate,
yeah. I suppose it would be a whole different story if Russia were announcing unilateral increases rather than cuts. When they're cuts, of course, you say shukran kathir, habibi. Rustin, I wanted to get your views on there was some commentary here earlier in the month by Mike Muller indicating the possibility that with all of these new sanctions and uncertainties around the legal definitions of all of this stuff, that the lawyers would be taking some time to pour through the paperwork. And so we could see a lot of oil and oil products in particular, given they were the new kid on the block in terms of sanctions, ending up in a lot of floating storage as ships have to take their time on slow sail before the lawyers could sign off on going into ports. Are we seeing any signs of that emerging?
Well, again, we're seeing supportive tanker markets due to longer ton miles. What makes a longer ton mile? A longer voyage, or ships being bottlenecked in a port, causing longer time for the voyage to come to an end. So, I mean, there have been signals of that. I mean, I think when you start adding the product flow into the equation, I mean, when I think of the Russian production cut, which seems that the point of discussion today is that's 500,000 barrels of cuts. That equals basically a couple of refineries being shut in because they can't find homes for the products that those refineries make. They can max out their crude exports, but the bottleneck they're always going to have is going to be on the light end products, naphthas in general, because there's no natural home for the naphtha that they produced other than the EU. And so it will result in some type of production cut because refineries will shut down and they can't export infinite crude, so they have to shut in the crude to match the refinery output that comes offline. But nevertheless, when we start looking at the legalities of the way that the sanctions and the price cap has been written, everything has to land into a tank and have a sale in order for it to become unprice capped. Now, to change that price cap definition as well, it has to change its customs code. So there's that legality of how do you change a custom code from product A to product B so you can re-export it. Well, that usually happens through transformation, i.e. through a refinery. So crude goes into a refinery, gets turned into other products, and then those products can be exported all over the world outside the price cap. With finished products, you have to blend, or you have to run it through a different processing unit. So if you take, for instance, naphtha that's price capped and you put it into a bunch of crude oil, well, that naphtha is no longer naphtha, it's now crude oil. And that crude oil can be exported back to the market at whatever the market value of that crude oil is. So there are a lot of legalities that have to be looked at and examined to see how you can make the oil flow and how you can keep trade moving without having too many bottlenecks at the end of the day.
Just to quickly follow up on that, Rustin, we had in the past sort of had quick check-ins about congestion at ports, supply chain disruptions, all of that. One of the expectations with China reopening was that it would clear up these supply chain disruptions that were a big participating factor into elevated inflation around the world. Are we seeing that happen? Are the China ports easing and getting back to business as usual?
Demand for container freight is pretty poor right now. $900 for a container to move from Shanghai to Europe. That's pretty poor earnings for the container markets. Where a year ago they were at 22,000.
That sounds nearly below cost. I don't know, is it? But
it is cheap. So the bottleneck that's starting to build up is now, what do you do with all these boxes that have gone to some disport and they're just sitting there and they're building up in warehouse space? Same problem that you're seeing in the United States is that because goods have come in and demand for consumer goods is not robust, both in Europe and the United States coming from China, you see warehouse space starting to go at premium. So that warehouse space where the boxes come in and they sit and wait for somebody to pick them up from distribution hubs is starting to increase in price. And so that is going to translate back into consumer goods. So I actually think we're probably in a position to see a secondary ramp up in inflation because that handling cost is going to start increasing. And until China's factories actually come back and actually start producing things, which actually increases demand for freight, especially on the dry bulk container side, which is currently lackluster. I mean, I'm not a buyer of the Chinese recovery story, saving the world.
Let's go to the survey question and get a chance to express that view in this poll that we'll put out on social media today. Will OPEC Plus have to raise supply in H2 to meet the IEA outlook for 2023 demand growth of 2 million barrels per day? Most of the commentary, and there's a big article by Javier Blas on Bloomberg today saying from his homework and reporting, OPEC Plus will not increase supply this year. But I'm asking our community is whether OPEC will have to raise supply to meet that demand, or ultimately, I suppose they can choose not to and watch prices soar above $100 a barrel. Yes or no on the question?
You have to think that demand is actually going to be there.
Yeah,
Yes.
well, believe Fatty Barol. Maybe we should stop doing that. I don't know. No, that's unfair. A very, very competent professional and his organization. I mean, we all call it wrong half the time anyway. The survey questions there. Neil, I wanted to get your views on another story we're carrying in the digest today about hedging. Major oil producers, including Petronas and Hess, have locked in hedges to protect against falling prices, and the latest sign that markets are stabilizing and extreme volatility is over. What are your thoughts on that? What does it tell you?
Well, I assume that what I don't know is what proportion of their volumes they're hedging at whatever price it may be, because of course, only a fool hedges, right up to the max. So I think it does.
Well, for example, we are seeing now in the US, natural gas producers who didn't hedge are having to shut up production because the cost of their revenue is lower than their income is now lower than the cost of production.
Yeah, sure. The markets are dynamic, they change, the outlook changes. So it's only sensible that they're hedging. I don't know how much they are, what proportion they're hedging and at what price. But I do buy in the short term at least, the market's stabilization argument. And I do buy, although I know Rustin is more skeptical on this, and that's entirely respectable, but I do buy the strong demand growth theory for 2023 as a whole. And I do believe, therefore, that based on the current numbers, if nothing changes, which of course, obviously it will, but if nothing were to change, then I think we could find prices rising during the second half of 2023, raising the question about what the response from OPEC Plus might be. And just finally on this, because by the time we get to the later part of 2023, the grim prospect of the US election in 2024 starts to raise its head, with the possibility of the return of the psychodrama we had in 2022, with prices possibly heading to levels which are politically uncomfortable.
Ali, some final thoughts for you on what we've seen in the last 24 hours. Of course, Iran, the Iranian leader in China being very well received, red carpet and all of that, and announcements of Iran and Russia military ties deepening. The axis of Iran, Russia, and China developing. How do you see that for the region? I know it's a fairly big question, but is there anything there? The whole Iranian position, which was very much front and center last year on the point of the nuclear agreement, which is clearly now dead. But now we have this axis emerging at a time in which we have an Israeli government that is increasingly sort of advocating its hostility again towards the Iran nuclear program. Anything to be concerned about here?
Well,
Sitting in the region?
I think Iran now at the moment they are just trying to to improve their image after the internal issues that they were facing a couple of months ago, and now it is more better than what it was 3 or 4 months ago. So now they are just trying to try and to improve their image, and they're not only talking to, and they have good relations with China and Russia only, but they are trying their level best actually to be together with the Saudi Arabians, to engage with Saudi Arabia and to start the dialogue again. And it started because of arrangement of Hajj, but I think this was just the beginning of a better engagement in the future. So Iran, I think it is in a position now to start moving out of this position that they have put themselves in, and to start looking for alliance. I mean, of course, Russia is one of them. It's very close. They're exchanging missiles. They're exchanging, they're exchanging so many things, including oil. But also China is a very big market for the Iranian oil. So it is always good. It is going to bring, I hope, some stabilities, especially if this talks with Saudi Arabia will improve, and also it will include, of course, the UAE and others in the region. So it's a very positive move. But again, with a new government in Israel, so it's another dilemma that we need to, or Iranis, they need to deal with, and especially with Netanyahu in power, and he's known to be anti-Irani, relationship with anybody in the world. With so we have to we have to wait and see what is the output will come. We know now that the nuclear deal is out of the picture now. So we have to rely on the good relationship that the Iranis will try to come up with their neighbors. So it's a good move, but it is too early to see what is the impact.
Well, dialogue better than no dialogue, I suppose, but nonetheless, something to keep an eye on. It just strikes me that the status quo cannot just remain festering away. Rustin, last word for you with the survey result. Given the sort of...
Wow. Wow. I wasn't expecting this.
And that's why markets are stable.
Well, they say it's a 50-50 world at the moment in terms of the equity markets and everything else. Everybody looks at the glass and either sees it half full or half empty. I wanted to get your thoughts, Rustin, just wrapping up on where I'm just reading some reports that given the sort of current situation that tankers that may be due for retiring, and with the new sort of carbon demands coming into shipping, we had IMO 2020, and now we've got new targets coming. Will we see the retirement of tankers, or will we see that delayed, do you think?
Well, it's been delayed. I mean, if you look at tanker rates, how they were 2 years ago, when they fell off of the highs from 2020 to 2021 and 2022, you would have thought you'd see a spat of scrapping, and that scrapping hasn't happened. And it didn't happen. It doesn't look like it's going to happen because now you have two markets. You have market A, which is abiding by all the international rules of trade and the new CII regulations, EEXI, and now we have the EU ETS coming in. And then you have the quote unquote dark fleet, which may or may not comply with all these rules and regulations and could become older and older and older as those ships find work. So because you have these two channels of trade now, that adds extra life to probably tankers going into a 25, 30-year lifespan, which then puts, of course, the world at risk of some type of major catastrophe with an oil spill, collision, what have you. The new rules are going to realign the fleet. Some vessel owners are doing fleet rejuvenations when they can find yard space, because with all these transitions, the types of ships that are being built in the shipyards are more modern, more fuel efficient, with more bells and whistles around how to reduce emissions. And on top of that, we're seeing a lot more variety of ships being constructed, i.e. more gas carriers, because a lot of the new fuels are going to require different type of tonnage than the current tonnage we have today, especially when you start thinking if the world transitions from petroleum into an ammonia-based fuel, well, that's a much different type of vessel than an oil tanker. We are seeing this transition happen within the industry, not only in tankers, but in dry bulk and in containers, and it's probably going to continue on for the next 5-10 years as we start getting into new technologies.
Well, maybe that's what the one tanker goes to die and retires into the dark fleet rather than into the scrapyards of India. We have Brent crude oil trading again. We wrap up. It's sort of 0.5% up. I suppose we're in a market in which I don't know what the question is, but the answer is $85 on Brent. So that's what is the things at the moment. Hard to see anything immediate to shift that off its axis. Thank you so much, as always, Rustin, Ali, and Neil. Hopefully we'll see. I think Neil and Ali in London at IE Week. I'm not sure, Rustin, you're going to be able to make it, but hopefully we'll have a rare opportunity for all of our commentators to gather in London and say hello. So that'll be nice. So thank you very much. We're here every morning, 10:30 UAE time. All the best.
Thank you much. Have a good day, everybody.
Thanks,
Cheers.
Sean.
Have a good
Nothing on Raquel Welch.
Well, you just had it. You had your moment. There it is.
That was the 80. That's why the price is up a little bit this morning. It's terrible news,
I'd have to say that's true. It is from all sorts of reasons that we won't discuss here.
See you soon.
Cheers.
Bye.
Bye.